Advisors Economic and Market Update for the third quarter of 2022. I'm Ben Yeager, and here today with Curtis Bird. Well, this year has been an interesting one so far. We certainly have had a lot of talk to talk about in our update today.
Mhm.
Curtis, I suppose we should just go ahead and get started off with a recap of the latest quarter and some of the ongoing trends.
Yeah, well, Ben, it's been a tough start to the year. Starting with market performance, it's been multiple decades since both stocks and bonds were down at the same time. Not to mention at some points both being down more than 10% each. So we found out, this definitely makes investing a little bit more difficult because, as we all know, bonds have historically been the ballast in a portfolio, allowing for a relative safe haven away from the more rapid price movements that you see with stocks. But even with the recent uptick in valuations with both stocks and bonds in July of this year, they're both still down year to date, with peaks having occurred earlier in the year in January. Another pain point so far this year continues to be inflation. In June, we saw a staggering 40-year high reading of inflation, with consumer prices being up more than 9%. I think back to 2020 when we had the hope of inflation being transitory or temporary, but clearly that is not the case. There are several factors that are making inflation a little bit stickier than expected. Um, I want to say, our hearts go out to Ukraine. We're hopeful for a speedy resolution to the conflict there. But from an economic perspective, this war has really been exacerbating that increase in food and energy prices that we've been seeing. COVID is definitely still around. Yes, the Omicron variant has been subsiding, but COVID is still disrupting the global supply chain. More notably with China and their zero tolerance stance with COVID. Yes, they've been easing their policy restrictions to a degree, but there's still that relative slowdown in production, and that's certainly been dampening the global supply chain. Understanding that inflation is largely a mismatch of supply and consumer demand, the Federal Reserve and several other central banks have been tightening monetary policy with the hopes of fighting inflation on that demand side of the spectrum. The Fed in particular, they've been on a tear of interest rate hikes.
Yeah.
In May, they raised by 50 basis points, 75 basis points in June, and then another 75 in July, and are signaling more hikes to come.
Mhm.
So they have to be careful though, because they're walking a tightrope. Because if they raise rates too dramatically, they'll invoke a recession. So Ben, with that in mind, what's Hilltop's outlook with all of that information?
Well, yeah, I mean, sort of what you alluded to is there's a lot of uncertainty in the world, particularly
Hmm.
around inflation and economic growth. And this really
Yeah.
spans not just the US, but the globe. And this uncertainty has widened the range of possible outcomes as it relates to the markets and the economy. So, first off, maintaining a diversified investment portfolio we think is crucial in times like this. But as you mentioned, Jerome Powell and the Federal Open Market Committee have made really aggressive rate increases in the last quarter to bring down inflation. In addition, they're now unwinding their massive long-term bond portfolio that they built up during the last decade of quantitative easing. And this has pushed up interest rates across the maturity spectrum from short-term
Mm.
bonds, long-term bonds, including 30-year mortgages. And so their goal is to take money out of the economy, slow down spending, get inflation under control. However, slowing the economy, as you mentioned, is brings in that risk of a recession. And they're hoping to ideally orchestrate what they call a soft landing and
Hmm.
keeping the U.S. out of a recession while also taming inflation at the same time. And the good news is that there look to be some early signs that inflation might be peaking. Most notably, oil prices have dropped. Gas prices in the US have also dropped over the last month. Wheat and several other commodities dropped in July, and even airline prices are falling now
Hmm.
as well.
Hmm.
So, some good signs there. The more concerning news is that the economy has also already slowed in the first couple quarters of the year. So far in 2022, we've had now two consecutive quarters of economic decline,
Hmm.
minus 1.6% in the first quarter and minus 0.9% in the second quarter.
Yeah, and Ben, those are very important data points. because there is this popular definition of a recession that's floating out there that it's two consecutive quarters of GDP contraction. So, with that definition, some would argue that we're already in a recession, right? But I don't think that the recent GDP outputs are necessarily telling the entire story. Jerome Powell and Janet Yellen have pointed out the strength of the labor market as signs of maybe we're maybe not in a recession, or at least not yet. So while there is still some debate, I'm curious to see if the National Bureau of Economic Research will officially declare this episode a recession or not. But of course, time will tell. But Ben, with the backdrop of poor market performance, stickier than expected inflation, a tightening of monetary policy, it's really becoming more clear, why consumer sentiment has declined. But
Yeah.
growing up as student athletes, I'm positive we've
Mhm.
both heard the phrase. It's not about how you start, but how you finish. So Ben, as we look ahead into the third quarter, can you touch on how Hilltop is positioning clients to really take advantage of the market environment that we're in?
Yeah, so I think what's most important is they have a really solid game plan for the next quarter. Whether the
Hmm.
markets do well or not, we need to be prepared for that. And the number one is being diversified. Stay diversified. Don't abandon a long-term plan. The
Hmm.
markets are especially unpredictable in the short run. Making big bets in one investment tends to increase in volatility and only magnify poor investment choices. So make sure that you're investing broadly. But then as you're doing that, we're looking into opportunities at the same time.
Hmm.
Recessions and drops in the market like this tend to uncover opportunities. So we're seeing mid cap stocks and small cap stocks trading well below their long-term valuations. Emerging markets are showing signs of opportunity, and even international stocks are well below long-term valuations as well. Bonds, short-term bonds, are now many of them yielding more than 3%. That provides, a good yield as we go through these recessionary symptoms
Hmm.
and work our way through the markets in this uncertainty. The other side of it is minimizing the exposure to some of these risks. If there is a recession, how do we create a portfolio that can weather that? And we believe that corporate real estate is a great tool to use within a portfolio to hedge against both recessions and inflation risk. And in addition, shortening our bond maturities. We've done that throughout the year as we've seen these better and higher yields on the short end of the yield curve, reduced our interest rate risk, and then collect a good yield while we're holding those positions. And then lastly, looking for rebalancing opportunities with the volatility in the markets. There tends to be some pretty significant price swings. And so we're monitoring our portfolios daily for opportunities to rebalance into undervalued segments of the market. And with that, looking for tax loss harvesting
Hmm.
opportunities. When positions are down and have losses, we can go in and realize those losses from a tax perspective and help our clients pay less in taxes down the road. Again, it's most important to have a great game plan, well-defined investment strategy as we go into these next couple quarters, no matter what happens with the markets and economy, that you're well positioned to have a strong finish to the year.
Wow. Well, Ben, as fiduciaries, it sounds like there are several items for us to keep an eye on, and that we definitely have our work cut out for us. To everyone out there watching, hopefully you were able to take away some useful information. And if this creates any questions about your financial planning or your investment management, we'd certainly enjoy hearing from you. I'd be remiss if I didn't mention the Hilltop website. Definitely check out our blog section when you get a chance. Thanks everyone for watching, and I hope you all take care.